One. And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Ravi, who's the CEO of Cantaloupe. Ticker symbol is CTLP. And it's his second time on the show. Ravi, thank you so much for coming on the show. We greatly appreciate it.
Adam, it's great to be back here, and I look forward to the conversation.
So can you just start, Ravi, by giving us an overview about Cantaloupe and explain some of your competitive advantages, please?
Yeah, at Cantaloupe, we are the largest technology provider enabling self-service commerce in North America, and are on a journey to be the largest technology provider powering self-service commerce for the whole globe. And in plain English, what we do is we build the technology that accepts payments at unattended locations. So the payment by definition has to be self-service because there's no store clerk there. And then we use the acceptance of payment combined with telematics to make an autonomous location dispense a product or a service. The product could be a bag of chips from a vending machine. The service could be a car wash or a parking gate opening and closing. So in all those scenarios, we build the telematics to interface with all those machines and make them dispense the service or product. And we also build the self-service optimized payment acceptance device that takes credit card payments, Apple Pay, loyalty cards, and various kinds of payments. And we also process the payments behind the scenes and offer software as a service that lets companies that have these self-service kind of businesses. I mentioned parking, I mentioned car washes, vending, cafeterias where you can grab, scan, pay at a kiosk and go. All those types of businesses, we provide software as a service that's kind of like the ERP for them to manage their business, sitting in their office at a computer, and they get visibility to inventory levels in warehouses, different locations, drivers needing to be scheduled to go out and restock, all of those things. So that's kind of the business in a nutshell.
I love it. So you're a publicly traded company. We can see the numbers. You're expected to be profitable this year and again next year. So I was going to ask you, how's business, but I'm assuming business is pretty well, but I'd like to hear it from you. How's business?
Yeah, it's very exciting time for us at Cantaloupe because we've had a real renaissance in the industry as a whole, with more people moving towards self-service. And I think that trend is just, at the very beginning of kind of a secular long-term trend. As far as the company itself is concerned, we went through a bit of a turnaround phase between 2020 and 2022. And that was driven by, COVID caused a lot of people to not show up at offices. And a good portion of our business is driven by office break room experiences, whether they are vending or whether they are, as I mentioned, grab, scan, pay and go experiences. So that took a hit. And then we also had some issues with a prior management where the company was delisted, went through some trouble. And so there was an activist shareholder, Hudson Executive Capital, that came in, reconstituted the entire board and the management team, including bringing me on. Right. And we sort of set up a turnaround phase for a couple of years and then a growth phase beyond that. And I'm happy to say we've executed on all metrics that we laid out for ourselves through the turnaround and are now well into the growth phase. And at an analyst day at the NASDAQ last year in December, we outlined a 3-year vision for the company, along with operating metrics and financial metrics. And that's created quite a bit of excitement. And as we've now had a few quarters of executing against that plan and building credibility, in this bad market where most companies are pushing their 52-week lows, we are pushing our 52-week highs. And, the Russells had near negative returns, and our stock is, since I've been in the seat, our stock is up 120%, which, not that I want to set myself up to sustain that every 6 months, but very excited about the market response so far. And we're just beginning this journey. So it's really early days and lots of upside.
Yeah, no, I love it. I mean, your stock is up 70% this year or thereabouts, if I'm correct. And yes. Yep, and it's more than doubled from the October lows of last year. And
Yeah.
hats off to you. The vision is the execution, phenomenal job. The turnaround is obviously working. The stocks, you guys are expected to earn around 7 cents this year, and then 23 cents next year, which is an increase of almost 230%. That's fantastic growth.
Yeah.
So
Yeah.
let's talk about that vision of future and the compelling future, the growth possibilities. Where are you located now as far as geography? Are you only North America? Are you international? And then your plans to expand going forward?
So we have historically been very strong North America. So that's US and Canada presence more. And now Mexico is included in that. So continue to consolidate our presence there. But we are now also going into Latin America more broadly and Europe. So add those as kind of a phase one international expansion. I describe it as a 3-year journey of setting up operations, setting up partnerships, sales teams, and starting to actually derive revenue. We are around the midpoint of that 3-year journey for those geographies. So we now have some revenues that are already coming from those geographies, though it's not meaningful for this fiscal year. And our fiscal year ends in June. So we are at the last few weeks of our fiscal year. But in fiscal 24, which begins next month for us, we expect to get to much more meaningful and material revenues. And by the time we get to fiscal 26, which is a couple of years out, we expect international to be 15, maybe even 20% of our total revenues.
Oh, I love that. And then I know your company has very little debt. What are your plans there with debt, and how do you use it, or do you get rid of it, or what are the plans with that?
Yeah, so we are in a net positive position in terms of cash on hand versus debt. It's always a choice to take down some of that debt, and we continue to evaluate that kind of on a quarter-to-quarter basis. If interest rates stabilize, maybe even head down, there may be less incentive to do that versus other opportunities for capital allocation. If interest rates continue to stay this high, then there is incentive to kind of take it down a little bit and use some of our capital for that. So it's an ongoing conversation with the board and with the leadership team to look at the best use of the dollars that we're generating out of the business as well as what we have from debt. So
yeah, and the company has a lot. You have to keep free cash flow, so it's
right.
a great position to be in. And I know management owns a bunch of stock. You've got funds own a bunch of the stock. The next question I have for you, Ravi, is with respect to I guess undervalued areas or undervalued areas that you can grow in. Where are some areas that are you looking to grow? Would it be possibly AI, yes or no, and or other areas that you can speak to, please, for investors?
AI is going to play a major role in many industries, including ours. And in ours, there are a few specific areas where we've invested heavily and are now starting to see some returns, and we'll continue to invest heavily in those areas. So number one is AI-powered merchandising. So when you think about these unattended locations, whether they are little bistro at an airport, which is selling salads and sandwiches, to to lockers, to catering, dining ahead, there's a convergence happening of all ways in which somebody wants to shop for their food and beverage, right? The online experience, the delivery experience, whether it's an Uber Eats or things like that, the break room experience, they're all converging. And the hot food cafeteria, which used to be in corporate break rooms, is going away. It's going out because too expensive, not economically feasible, labor shortages, all those are driving it out. So, which is great for us. What that leads to is I want to be smart about freshness and variety, right? So if I'm at an office location, I don't want to eat the same turkey sandwich every day for lunch. I want to have sushi one day, and I want to have a tuna sandwich the other day. So it's just creating that experience requires a lot of intelligence, and AI is great at that kind of merchandising. And it could be even as simple as blue Gatorade in a vending machine versus Coke on a particular time of the year, or whatever, those types of decisions, right?
Right,
and we're finding a lot of value from that. That's one. The other place where we use AI pretty heavily is what we call dynamic scheduling. So before we built this innovation, you used to have people show up every Tuesday to restock, whether it's office coffee supplies or or these marketplaces or whatever. And the problem with that is half the time somebody would show up with, a lot of stuff, and they would find that sales hadn't happened and they wasted a trip. And the other half, they would find out that they showed up and the shelves were empty for 2 days and they lost sales, right? So on both sides, it was negative. And with our dynamic scheduling, now it's real-time inventory across warehouse and locations, optimized for forecast sales, using artificial intelligence. So, and then doing something called pre-kitting. So what happens is in the warehouse itself, they build kits for each location that are exactly tailored to what is needed to be restocked at that location.
Okay.
The algorithms and artificial intelligence optimize when a driver is going to go to a location. It's not every Tuesday or every Thursday anymore. It can vary, and it's dynamically scheduled. And it gives them their, pick list, and it gives them their products, and it gives them their go here on Monday and don't go to this other place. And it's very intelligent in terms of taking into account factors like, hey, you're anyway going to this place. So even though this other place is not fully empty, it makes sense to go there, right? Stuff like that.
Right.
So those are two big areas where we are doing a lot with AI. And then we are doing a lot with AI around trouble management. So especially when you have unattended locations,
Okay.
if that parking gate has a problem and it's not opening, you're going to have some very pissed off customers, right? Especially if they're stuck inside. So
No
being
question.
able to proactively detect something, right, and then dispatch for trouble is another big portion of kind of what we do, right? So that's hopefully that gives you some color on the AI side.
No, I love that. And then is that proprietary AI, or is that just ChatGPT, or is it, how does that work?
So it's the dynamic scheduling piece and the merchandising pieces so far have been proprietary AI, but they use fairly standard algorithms that are used by the broader retail world in terms of doing basket analysis and several things like that. Some of it is protected, very proprietary and protected by our patents. We have more than 70 patents, and that creates a nice moat for our business against competition, right? And so some of this is in that category. ChatGPT is exciting for us in accelerating our customer support experience and in accelerating our internal kind of data intelligence platforms and things like that. So we're doing a lot with ChatGPT, more in R&D at this stage in those areas, right? And I think it's early, but I'm very excited about what could come out of it. And not to mention the organic, at our company, I've encouraged people to, in a compliant way, experiment. And so we've got marketing people writing content using ChatGPT. And I even have somebody who wrote a contract using ChatGPT, and our chief legal officer was actually, this is actually not bad, so it can be a time saver in many different areas. Engineers are obviously using it to write and refine code in some cases. So in a lot of places, we've got it. We're also putting a lot of controls in place to make sure we don't shoot ourselves in the foot from either compliance perspective or, ChatGPT is stealing someone else's code or copying content from somebody else's website. So we've put controls in place to ensure all that doesn't happen.
No, that's wonderful. I heard of a crazy story. A lawyer had used it for some kind of historical precedent, and it was just all bogus. It was all wrong.
Yeah.
He got nailed for it. Okay, wonderful. So two follow-up questions to all of that. First off, you mentioned to make sure the risks don't happen. So, like, in other words, a machine doesn't not open, right? So how do you handle risk? And then what steps do you take to mitigate risk and or help with risk management?
Yeah, it's what we call telemetry, which is, we try to get a lot of data points in the operating environments that we are present in. So that way we can detect trouble way before it manifests in an actual problem that impacts the consumer's experience.
Okay.
That's really in a nutshell how we handle that. And it has a lot of value, and we charge our customers a per month, per location price for it. And it's a good profitable business and adds a lot of value.
Excellent. And then the next question with respect to growth going forward. I know you guys, by definition, you're an innovative company. You see things. What areas are you looking to grow into where either you haven't been there or you're just starting to scratch the surface there for more growth with your 5-year plan?
The EV charging space is one of those, not the only one, and amusement is another. Now, these are all areas where for a variety of different reasons, the opportunity is starting to mature. So what happened in EV charging was everybody came up with, hey, I'm going to search for a location on my app. I'm going to find it, and then I'm going to make the payment and do everything on my app. Well, now the states, and California in particular, are starting to take the lead in saying that's not an inclusive solution, and you need an open loop payment solution where I can use my credit card, I can use other normal payment mechanisms, just as I can at a gas station, right? So now the charging station manufacturers who didn't build that into their solution out of the gate are looking for retrofit opportunities where they can collaborate with somebody like us and say, put a card reader on there and enable the telematics to tell the charging station to dispense charge. And also, by the way, now that you have that, a company like us can monitor the efficiency of the charging station. We can monitor its connectivity to the grid. We can report on all the transactions in a very clever manner. So there's a value chain that we are ascending, if you will, in that space. Amusement is another, we have a pretty good presence already, but there are various types of gaming machines in bars and in various other locations that are all suitable for self-service payment and telematics, and we are expanding that pretty aggressively as well.
I love it. No, the EV stuff and even the amusement stuff is fantastic, especially as people want those experiences, the EV cars. I just had the CEO of Wallbox on, which they specialize in making EV boxes. And they have it where the generator for your house could be your battery for the car. So the car could, battery, it's fantastic. So, okay, that's beautiful. I guess my next question from a shareholder standpoint is the growth looks very clear that in my mind's eye, at least I see that the risk you're doing your best to mitigate the risk. Let's talk macro for a little bit, the overall economy and fear of a recession, the Fed raising rates. How does all of that factor into your plan going forward?
Yeah, there are some things that can be tailwinds for us and some that can be headwinds. I'll outline them. If we have a recession that prompts a lot more companies to lay off a lot more workers, that's headwind for our business, because we do drive a lot of business through break room experiences at companies. Now, what we've seen so far is that the layoffs have been restricted more to tech and very high-end white-collar jobs. When you get to lower income workers, the opposite is true. There is severe shortage, and that hasn't changed. And there are 3 jobs for every person, right? Almost. So we have a long way to go before I think that problem can become a reality. But in past recessions, we've seen unemployment climb very steeply, very quickly. So that's a risk, right? The tailwind side is if the bargaining power, which has been heavily with employees, especially in white collar jobs, starts shifting because of recessionary conditions more towards employers, then you might have more employers, like Google did, like some of the other companies have done, start asking workers to come back to the office, which is tailwind for us. So if workers come back instead of 2 days a week, 3 days a week, and if more remote workers start thinking that, hey, I better be in the office and interacting with people or my job's going to be at risk, that's actually a positive for us.
I love that. Anything else that I didn't ask that you'd like to share, Ravi, before we wrap up for today?
I think just you covered a broad swath of everything. The one area which maybe we didn't touch on is, hey, how are you getting operating leverage in the business, and how is the profitability growing, this sharply? Because our forecasts for the long term, or our outlook, call for an EBITDA growth rate, a CAGR of 70%, right? However, the top line revenue is growing at 15%. So that throws some people off in terms of how are you growing revenue at 15% and yet you grow your EBITDA at 70%. So the answer is this. At least when I got here, the business was more heavily tilted towards equipment and payments, and software was kind of a third leg of the stool, right? Not necessarily the big portion. What we've now done is we've outlined a strategy where software is going to become the biggest part of the business. Okay. And software has, just to break that down, historically, equipment margins have been negative, -5%, -10%. And it's the razors that you sell to sell the razor blades later, right? And the payment processing margins historically were at 8 to 10%, and they were stuck there for many, many years. And the software margins were good. They were at 80%, but the software business was growing very slow, 4 to 6%. So what we've done is we've done a number of pivots and invested heavily in R&D on the software side to build a lot of new modules and a lot of additional things. The AI-powered merchandising is a good example. Ability to change prices remotely is another example. So as a result, now we have shifted to where this fiscal year, our software growth or the subscription revenue growth has been in the teens instead of being 4 to 6%. And next year and onwards, we see it in the low 20s. So we'll grow the software revenue at a much faster pace in the 20+% rate, right? And that's 80+% margin. So as this becomes a bigger portion of the pie, the overall profitability of the business improves drastically, right? That's one. The second thing we've done is we've looked at the payment processing revenue very carefully and how we route payments and made some significant improvements there that have now brought it from the 8 to 10% where it was for many, many years to the 14 to 16% in the last several quarters. And we've consolidated that expertise and proven that we can do it, not just, flash in the pan one quarter, but repeatedly and consistently. And we have a pathway to get it more closer to the 20% mark. So there is, when we looked at it carefully and we said, here are all the levers, here's all the work we have to do, we kind of outlined a 24-month roadmap, and we're at the midpoint of it, and we've realized, let's say half the gains. So that is another driver that makes it profitable. And in combination, these things are what is going to drive our business there. Plus, we've also stopped the heavier discounting on the equipment side, which have made that be profitable as well, though marginally. It's not, going to get to the double-digit or significant margin numbers, but at least we're not burning as much cash there. So that in combination, all these three things have led to the better profitability and the better trajectory for profitability.
No, I love that. So when you said you're going to sell more software and make that piece of the pie bigger. Is that selling to existing clients, or is that going after new business, or both?
Both.
Both.
More of it is, I would say 70% is still continuing to upsell current customers. But there is a 30% factor, which is more selling to newer customers and newer logos. So it's a combination.
Got it. And then your R&D that you're creating the new proprietary, all your patents, number one, number two, your proprietary AI, so on and so forth. One of those things, do they have the ability to have a J curve where it could be exponential type growth, or are those things more moderate growth as far as leading to the bottom line growing?
So in terms of the revenue growth, as of now, it's all aimed more at continuing to expand that software side and making it more profitable. However, like any company we have, I call them our list of 3 to 5 moonshots that, if they take off, then they can drive exponential growth. So we make a few of those bets, but we're very disciplined about, let's not, from a capital allocation perspective, that tends to be in the 10 to 15% of our CapEx, overall R&D CapEx. And the rest tends to be very focused on, driving better profitability and driving incremental growth in the core business.
Understood. Yeah, you just said revenue. You meant as far as earnings are concerned, right?
Both.
It drives revenue and earnings. Got it. Okay, wonderful. Well, beautiful, Ravi. This has been super fantastic. The company's Cantaloupe, ticker symbol is CTLP. Everybody go check it out. If people want to get in touch with you, Ravi, what's the best way? They go on the website, or how should they connect going forward?
Yeah, the website is great. My email is R Venkatesan, which is my first initial and last name, @cantaloupe.com. That's a great way to get in touch as well.
Beautiful. Well, thank you so much. Hopefully we'll have you on again soon.
All right. Thanks, Adam.